Over $1 trillion in market value disappeared in a matter of weeks. And if you've been following me here at my channel, you know I've been bullish since the start. I believe fundamentally Bitcoin is the soundest form of money humanity has ever created. But the truth is, the market has now slipped into bearish territory. There's no denying that. No one has real clarity on how this year will close. We know momentum feels uncertain. Conviction is shaking down to its core, and the data is sending mixed signals is also the truth. So rather than guessing, we're going to shift our focus. And in today's video, we're going to look ahead at what could come next, why, what the data is actually saying, and which signals deserve our attention as we move through the rest of this cycle. All right, so let's get started to what triggered this crash in the first place. All right, getting started. So we know the first domino that dropped in this grand market unwind came and started in Japan. For years, global funds have borrowed yen at near zero interest and used it to buy higher yielding assets like the US Treasuries and stocks. That trade, known as the yen carry trade, has been one of the quiet engines of global liquidity. So when Japan's 10-year bond yield started rising again in November, that engine backfired. And suddenly, the cost of borrowing yen jumped, and funds rushed to unwind positions to cover their losses. So the same thing that happened back in August of 2024 when Bitcoin fell from 70,000 to 48,000 in a matter of days happened again. Except this time, the stakes have been much higher and the positions were much larger too. Therefore, the unwind was faster. And then came the second shock. The US Bureau of Labor Statistics delayed the October and November jobs report until December 16th, meaning the Federal Reserve would go into its final meeting of the year without the key data it relies on. So that single scheduling change created a blind spot for policymakers. So we then saw traders starting to pull back. Rate cut odds for December collapsed from over 60% to under 35%, and liquidity dried up overnight. And when liquidity dries up, the riskiest assets always take the first hit, and Bitcoin dropped through $90,000 and every major altcoin followed. And at the same time, money was flowing elsewhere, that is, into the AI boom. I'm actually thinking of starting to cover AI on this channel as well, or maybe I'll make a totally separate channel on AI, but I feel both of these industries have a lot of cross-pollination. But anyway, let me know what you think of that in the comment section. And carrying on, NVIDIA, we see just reported record-breaking revenue of $57 billion. And projected up to $66 billion for the next quarter, saying demand for its AI chips were sold out across the cloud. That kind, of corporate spending vacuumed up billions. And if we add it all up, tighter liquidity, global deleveraging, and an AI capital drain, what we have is the macro setup that triggered this crash. But that's only on the superficial level. The story, the real story, is what happened beneath this. So let's take a look at the bearish data we need to talk about. And let's talk about the signals that still matter, because they're the bearish signals that investors are paying attention to. And this ultimately affects the market. And right now, the biggest weight on this market is supply. Over 70 billion in altcoins are scheduled to unlock and come into the market between now and 2027. At current valuations, that's a tsunami of new tokens hitting circulation while liquidity is still tight. Many of these projects launched with tiny floats and sky-high valuations. And once those new tokens hit the market, they will need real buyers, and there aren't enough of them right now. And that's why alt season never came, essentially. Bitcoin dominance instead just kept climbing, and institutional demand stayed focused on the majors. Ethereum ETFs brought in smaller flows than expected, and the ecosystem is facing its own challenges. And we see that layer 2s like Arbitrum and Base are expanding fast, but most of their activity leaks value away from Ethereum itself. And Ethereum now captures only a fraction of the fees its layer 2 networks generate. Meanwhile, stablecoins like USDT and USDC are replacing ETH as the preferred settlement asset in DeFi, weakening Ethereum's money narrative. So even within DeFi, yield compression is real. Farming returns are lower, token incentives are weaker, and users are migrating to platforms with real revenue instead of airdrops. Naturally so. So if you're building a case for a short-term bull run, those are the headwinds you have to pay attention to. Supply overhang, network fragmentation, and cautious macro backdrop. Now, let's flip the script and take a look at the bullish structure beneath the surface as well, because there's always two sides to the coin. Right now, we see that on-chain data shows long-term conviction at record highs because the market's matured, I believe. Whales who have held Bitcoin for 5 years or more are still accumulating, which is over 43% of all Bitcoin supply that has been dormant for more than 3 years. And we see that selling pressure has come almost entirely from wallets that bought within the last 2 years, meaning new people or traders who chased the rally and then folded as soon as volatility returned because they didn't understand Bitcoin's fundamental value. And the network itself is as strong as it's ever been. Mining difficulty and hash rate both have hit all-time highs. And miner revenues are up 31% year over year. And we see that daily active addresses, transaction counts, and total transfer volume remain near the top of Bitcoin's historical range. So the fundamentals look like expansion, maturity, not contraction. And the same story appears on the institutional side of things in the institutional data. We see that Abu Dhabi's Al Warda investment tripled its holdings in BlackRock's IBIT ETF during the third quarter, bringing now its total position to just under 80 million shares worth over $517 million. And Harvard's endowment fund disclosed a $443 million position in the same ETF, which is roughly 1/5 of its US public investment exposure. So we have a situation where sovereign wealth funds and Ivy League endowments are allocating to Bitcoin even during these volatile days. It shows they see what FOMO traders miss, and that is the long-term store of value potential that Bitcoin possesses and inherently defines it. So even after the crash, ETFs are still net positive by over 60 billion since their launch. And the outflows of the past week barely dented that figure. And then there's DeFi. Token terminal data shows that Uniswap, Aave, and Lido all saw double-digit growth in user activity and fees in Q3, while their token prices fell. And this means usage is rising while valuations are setting, which is exactly the kind of divergence that precedes recovery. So yes, the price fell, but the structure held strong. So now let's zoom out. Because what if this crash was not destruction, but consolidation? Over the past year, crypto exploded with new ecosystems, we know this, and meme tokens, and high FDV launches. Liquidity scattered across 10,000 tokens. Every new idea got a ticker. DJ Sterling from Blockchain Capital calls the next phase that we're going into right now the Great Consolidation, a period when that noise gets cleared out and capital flows back to a smaller set of assets with real use cases. Bitcoin is consolidating value as digital gold, and Solana is consolidating users and DeFi volume. Meme liquidity is concentrating into a handful of global brands, mainly Doge, WIF, Bonk, Trump, those that have had the biggest impact and move culture. Meanwhile, Ethereum is being forced to address real structural issues. such as L2 fragmentation, fee leakage, and token unlocks. These are all pushing developers and investors to demand a new model where Ethereum captures more of its own value. That kind of pressure is uncomfortable and difficult because it's such a huge network, but it's essential, and this is how ecosystems mature. And we also see the same process happening across apps, such as Hyperliquid, Jupiter, and Uniswap. They're all evolving into super apps that own the user's relationship across multiple services, such as swapping, lending, trading, and yield. The projects that generate real revenue and keep real users will survive. So pay attention to that during these days, because these are also the tokens that will pump once the market recovers and starts pumping again. And the rest will vanish. So this is what every maturing industry goes through. After the dot-com bubble, thousands of websites died, but the ones that survived built the next decade of the internet. And the same thing is happening now in the crypto space. So it's not time to throw in the towel and to quit. It's time to reevaluate what you're holding. It's time to pay attention to who's still building, and it's time to get into position for the next rally. That said, it's important to take a look at the road ahead of us. So where do we go from here? Well, first, and the most immediate, we need to watch the Federal Reserve's December meeting coming up. The guidance it gives for next year, 2026, will determine how much liquidity comes back into risk markets. And if rate expectations soften, ETF inflows will follow. And secondly, we need to make sure we track on-chain metrics that matter, such as dormant supply, miners' revenues, and exchange balances. As long as long-term holders keep adding and miners remain profitable, Bitcoin's foundation is solid. And thirdly, you need to keep an eye on the unlock calendar. Altcoins with weak fundamentals will bleed as supply floods the market, and that pressure will push capital towards higher quality names and protocols that generate fees. This is the cycle's digestion phase. It's where speculation dies and fundamentals take the wheel. So in closing, here's the truth about the $1 trillion crash we all experienced. The price fell, yes, but the network strengthened. Speculators exited, but sovereigns entered. And the noise got louder, I know, but the signal got clearer too. Markets go through these moments because they have to. It's part of the process. They reset leverage, test conviction, and hand assets from weak hands to strong ones. So the $1 trillion wipeout didn't end Bitcoin's story. It removed the air around it. The fundamentals, the adoption, and the structure all point to the same conclusion. And that's Bitcoin's base layer has never been stronger. So the fear right now is temporary. The consolidation that follows will define the next chapter. So it's time to stay ready and stay plugged in. So be patient, stay data-driven, and remember, conviction built on evidence always wins the long game. That's the truth about Bitcoin's $1 trillion crash. If you gained value from today's video or have a clearer understanding of where we are in this market and what's to come, then just like the video and share it with somebody whom you want to know what's going on right now and how to prepare themselves moving forward. I love you guys so much, and I'll catch you guys here tomorrow. Ciao.